On the program today, South Africa's MTN to exit Middle East over medium term as part of plans to focus on Africa. Somalia expects to announce winners of first petroleum auction early 2021. And Telkom Kenya pulls the plug on merger with Bharti Airtel. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi. We get the show started with the markets, and Nigeria's main index reversed its three-day bull run at intraday, declining 0.11% due to losses from the banking and industrial goods sectors. On the flip side, South Africa's JSE index rose 0.75%. The EGX 30 in Egypt jumped 1.15%, while Kenya closed negative on Wednesday. And major Gulf stock markets rose at intraday, largely led by gains in financial shares. Dubai's main share index rose 1.36%, led by a 1.4% gain in Emirates NBD Bank, while the Abu Dhabi index was up 1.25%, with First Abu Dhabi Bank rising 0.7%, while telecoms firm Etisalat added 1%. Elsewhere in the region, the Qatari index jumped 0.96%, helped by a 2.4% increase in petrochemical firm Industries Qatar, while Saudi Arabia's benchmark index gained 0.47%, driven by a 1% increase in RG Bank. And the UK Bank of England holds rates steady, but warns of a slower economic recovery and higher unemployment rate. Well, let's see how those are being digested in London. Let's bring in Juliana now. Hello, Juliana. Good afternoon. Well, climate change protesters were seen outside the Bank of England this morning, demanding that the central bank stop supporting industries which drive global heating. What exactly do they want the BOE to do?
Good afternoon, Chimeze. Well, what they want is for the Bank of England to reduce the amount of carbon impact that they have with their corporate bond purchasing scheme. Now, in April, the Bank of England doubled their corporate bond purchasing scheme to £20 billion. It did stand at £10 billion before the COVID pandemic. And basically, what it is, it allows big companies to borrow much cheaper. And there is a report that has been conducted by the New Economic Foundation. It's being reported by Bloomberg. And what the Economic Foundation have realised is that there are large corporate giants, they call them pretty dirty industries, that have benefited from this CBPS, and they want questions as to why. They want answers as to why the Bank of England under Andrew Bailey have done this, considering that the Bank of England already have their own carbon neutral goals. The British government already have their goals to try and remit emissions, for emissions to be lower. We already heard from BP earlier this week, who said that that's their plan, because they want to transition from being a pretty dirty oil industry into being a company that understands that clean energy is the future. So they're not happy. So they're marching on the streets. I've got to say, this is part of a much wider discussion. There have been calls by some energy organisations who are questioning why the government is subsidising a lot of these big firms, particularly the airline industries, giving them bailouts, furloughing their staff, when they could have used that opportunity to start having an open discussion, saying, look, we're happy to help you in your time of need, but for taking the taxpayers' money, what we would like you to do is start setting some of these goals. So that's the reason why we see these groups picketing outside of Bank of England today. Nothing to do with the interest rates, but to do with how they're funding what they consider to be dirty industries.
All right. Well, talking about the interest rate announced this morning, the market must have digested that decision by the bank, and of course the warning on unemployment. Bring us up to speed with the intraday numbers.
Well, it's a pretty bad start to the FTSE this morning after that pretty gloomy outlook from the Bank of England. And at intraday, it hasn't been pushed up thus far. The all-share is down 1.19%. The FTSE 100 is down by 1.29%. And the FTSE 250, the domestic market, is down by 0.68%. This has in turn helped sterling, because in currencies, the pound is up on the US dollar by 0.50%, up on the euro by 0.62%, and up on the Japanese yen by by 0.45%. It's worth mentioning, Chimezie, that we did actually have some PMI figures today. It was the turn of the construction PMI. This is moderately cheering. It's risen to 58.1 in July from 53.3 in June. We know that PMI is registered between 0 and 150 is that balance mark between contraction and expansion. So we are seeing some expansion in the industry, but considering we're seeing potentially a 9% contraction in GDP in this country in 2020, those figures did very little to cheer up investors.
All right, we'll leave it at that. Thank you for the updates, Juliana. Enjoy the rest of the day. Meanwhile, European stocks were slightly lower in the morning as investors monitored a slew of corporate earnings and reacted to the Bank of England's decision to leave interest rates unchanged. Conrad will tell us more. Hello, Conrad. Good afternoon. Well, lackluster trading on the stock exchanges of Western Europe, including Germany, despite strong factory orders. In June, the German manufacturers got about 27.9% more new orders than in May. Why is this data not inspiring the German index more?
That's a very good question, Chimi. The factory orders came in to be much stronger than what economists had forecast. And of course, with order books filling so much more strongly and so much more quickly, that's a positive hint on what we can expect in the coming months in terms of industrial production. Still, the problem is if there's a big if and a big question mark hanging above all this, and that's, of course, the question whether Germany can avoid a second wave of infections and, of course, a second wave of lockdowns. And let's not forget how interconnected worldwide the German economy is. When we talk about a fear of a second wave, then we not only mean Germany here, we also mean our partner countries, the ones that we do trade with, in particular the United States. Lobby groups for the German industrial sector are already warning that it's absolutely not a given that we are going to see a strong rebound in the autumn. Something else is weighing on investors' minds, and that's the strong increase of the euro. It's now reached a level significantly above $1.18. If this continues, then of course it will noticeably weigh on profits of exporters, German exporters that make a lot of business in US dollars or US dollar aligned currencies.
All right, let's talk about earnings. Many German blue chip companies have reported earnings today, including Siemens, Lufthansa, Adidas. Who sticks out positively?
I think Siemens is worth mentioning at first. The large industrial conglomerate managed to report a much better earnings for the second quarter than anticipated. They say that in particular business with China is noticeably stronger. Also, a strong increase of the industrial software unit of Siemens is something that analysts are writing very positively about. Some of them are writing that Siemens is more and more a company becoming like SAP and not a traditional engineering firm. Adidas is worth mentioning, I think, which of course had to face many obstacles and problems during the first half of the year. A lockdown of shops between March and May. Also, cancelled and postponed sports events like the Tokyo Olympics and the Euro football championships. All those problems Adidas is saying is hopefully going to be left behind in the coming months. Online sales are strong. And also something else, the corona lockdowns, of course, have pushed the trend towards casual clothing. And that's something that, of course, Adidas can deliver.
Well, you didn't talk about Lufthansa. Well, the airline has reported a 1.5 billion euro loss for the second quarter. Now, what about the outlook? What does the outlook say for this airline?
The outlook is very bleak. Lufthansa is saying that it will hopefully be able to return to pre-corona levels with its business not earlier than in 2024. And that is, of course, a very long, difficult streak for the company to face. Lufthansa also says that it might focus on more rigorous job cuts. Up until now, 22,000 jobs were planned to go at Lufthansa. Now Lufthansa says maybe we won't be able to cut those jobs, the soft way, for example, where you have people, workers retire and you simply don't fill those vacancies anymore. Now, Lufthansa says no, we might not find a socially acceptable and consensual way with the unions to cut those jobs. And that, of course, is something that would be not traditional for Lufthansa. Traditionally, with all the fights that bosses had with the unions, they eventually found some way of compromise.
All right, thank you very much for your thoughts there and, of course, for sharing those updates with us. Enjoy the rest of the day, Conrad. Hope to see you tomorrow. And stocks in Asia Pacific traded mixed today as investors continued to watch tensions between the U.S. and China. Hong Kong's Hang Seng Index led losses regionally as it fell 1.63%. In contrast, South Korea's Kospi jumped 1.08% as shares of automaker Hyundai soared more than 5%. Mainland Chinese stocks were lower by the afternoon, with the Shanghai Composite down around 0.4%, while the Shenzhen component slipped about 1%. In Japan, the Nikkei 225 dipped 0.53%. Topix index shared 0.38%. Shares in Australia edged higher as S&P ASX 200 gained 0.25%. Overall, the MSCI Asia ex-Japan index was slightly lower. And futures contract tied to the major U.S. stock indices were little changed early today hours after the Nasdaq Composite claimed its 31st record close for 2020. Dow Jones Industrial Average futures implied a positive start to the trading day. S&P 500 and Nasdaq 100 futures were marginally higher. The moves followed a positive regular session on Wednesday, with the major indices brushing off a weaker than expected private payrolls report and the Dow rising some 370 points. The latest iteration of the Labour Department report on weekly jobless claims will be released later today. The weekly figures provide Wall Street with critical insight on how many Americans continue to collect unemployment benefits known as continuing claims. And away from the markets, they're back here on the African continent. South African mobile operator MTN Group plans to exit the Middle East over the medium term, starting with the sale of its 75% stake in MTN Syria as part of plans to focus on Africa. MTN is in advanced discussions to sell the stake in MTN Syria to Teleinvest, which is the minority shareholder in MTN Syria with a 25% holding. The group president and chief executive officer of MTN, Rob Shuter, says the Middle East assets, which also include operations in Afghanistan and Yemen, contributed less than 4% to group earnings before interest, taxes, depreciation and amortization in the first half ended June 30. The group also has a 49% minority holding in Irancell. Meanwhile, South Africa's Shoprite Holdings will lay off 115 staff and close another Kenyan store less than a year after its opening as part of the supermarket's expansion into the East African country. In the letter addressed to the Kenyan Union of Commercial Food and Allied Workers, Shoprite said it will close its City Mall store in Nyali, Mombasa. Shoprite says it's evaluating all of its operations across Africa based on current and future performance. In April, Shoprite closed one of its 4 stores in Kenya, citing a few months of trading in a difficult economic climate after the store was opened last September. The closure of the Nyali store, which opened on August 29 last year, will leave 2 in Kenya. Shoprite, owner of supermarket chain Checkers, has been reviewing its long-term options in Africa as currency devaluation, supply issues and low consumer spending in Angola, Nigeria and Zambia have reduced earnings. When we come back after the break, we turn our focus to the domestic commodities market and more. To stay with us. Just before we talk commodities, Telkom Kenya says it's no longer looking to merge its business with the Kenyan unit of India's Bharti Airtel, citing challenges of securing the required regulatory approvals for the deal. Bharti Airtel had said in February 2019 its Airtel Network Kenya unit had agreed to buy Telkom Kenya, the East African nation's smallest operator, in which the state still has a 40% shareholding after a majority stake was sold in 2007. The deal, whose terms have never been disclosed, would have created a stronger challenger for Safaricom, which controls more than 60% of Kenya's mobile subscriptions market. Besides the challenges of securing the required approvals for the deal, which did not elaborate upon, it also cited opportunities presented by growing demand for internet services on the back of the coronavirus crisis, which has forced many to work and learn from home. Among the hurdles the company faced in getting the deal approved include fierce employee opposition to a move to lay off some workers in July last year. And to commodities, now we're talking cocoa. Nigeria used to be the fourth largest producer of cocoa. It is now the fifth after being displaced by Ecuador and Indonesia. Despite the huge support cocoa producers get from both the federal government and governors of cocoa producing states, they are estimating an 18% decline from their targeted output of 265,200 metric tons this season. Well, let's get a sense of what is responsible for this trend. Aisat Dahoud, one of the research analysts with Financial Derivatives Company, joins us now to tell us more. Hello, Aisat. Good afternoon.
Good afternoon. Thank you for having me.
So cocoa producing states are estimating an 18% decline from their targeted output this season. What is responsible for the estimated decline, and what can be done to make Nigeria's cocoa output to be competitive with that of Ivory Coast and Ghana?
Okay, a major factor that determines the amount of output a cocoa farmer gets is how well the cocoa tree is nurtured to withstand black pod fungi that stems from heavy rainfall. And however, movement restrictions in the earlier in the year have caused scarcity of labor for cocoa farmers. Also, it has declined the availability of fungicides for them to use, because naturally they're supposed to prepare this cocoa tree, spray it at intervals frequently, well enough before every rainfall starts to occur. However, they couldn't do that. And the interesting thing is that Nigeria has the potential to actually supersede, Ivory Coast and Ghana's cocoa's output. Let's look at it. We have 300 and something thousand cocoa farmers in Nigeria. The yield per hectare for cocoa in Ivory Coast is about 100 kilograms per hectare. For Ghana, that's about 400 kilograms per hectare. And in Nigeria, we're doing about 500 kilograms per hectare. Indonesia is also among the largest producers, like you mentioned earlier. Indonesia is doing about 1,000 kilograms per hectare. So looking at all this, I would suggest Nigerian cocoa farmers should focus more on our yield per hectare, since we have the potential. A natural cocoa tree has the potential to produce for the whole hectare to produce 2,000 kilograms per hectare. So if we focus more on our yield per hectare, we should be able, aside expanding the land area, the amount of land area cultivated, we should be able to compete and even be more competitive than Ivory Coast and Ghana.
Now, cocoa is Nigeria's largest non-oil export. The country's non-oil export earnings estimated at about $3.9 billion, which is about 14.97% of the total export earnings. The global price of cocoa is forecast to decline by about 4.9% to about $2,200 per ton. So what will be the impact of this price decline on cocoa producers and Nigeria's export earnings?
Looking at it currently, the global price of cocoa is about $2,314 per ton. If, assuming we meet our targeted output of that 265,000 tons, like you mentioned earlier, we should be earning $600 and something million from cocoa. Should the price fall, like it's been forecasted by the EIU and the likes, if it should fall to $2,000 and $2,200 per ton, we'll be losing about $30 million thereabout. But if we don't meet our quantity, that's the target head output, if it should decline, and the price also decline, we'll be losing about $135 million. That's, the price multiplied by the quantity. And that difference is so huge, and it will have a huge impact. That's from cocoa alone. It will have a huge impact on our export earnings. So Nigeria needs to intensify on diversifying and expanding our source of revenue, foreign exchange earnings, away from oil. Agriculture accounting for just about a marginal percentage, because believe me, crude oil and gas accounts for about 90% of that, and that's very, very absurd. And we need to do a lot of things to expand our source of earnings.
And the two-nation cocoa cartel, Ivory Coast and Ghana, of course, introduced a $400 premium price for each metric ton of cocoa to benefit cocoa producers. Can this cartel be compared to the likes of OPEC? And how sustainable is this price increase?
Interestingly, we have 6 commodity cartels, including OPEC, and they're all unique in their various ways. So comparing this two-nation cartel with OPEC is that they're not comparable at all. So now let's look at this two-nation cartel. This two-nation cartel went on, initially, I recall they had a cap selling price of $2,600 per ton for every cocoa they sell, every ton of cocoa they sell. Along the line, they modified it to this premium $400 premium, like you mentioned. That's above the market price at any price. So suggesting they're selling at 2,200 or something, they will have the 400 premium price to it. So looking at this, they did this in order to protect companies, like you said, just to address the imbalance between the income of cocoa farmers and the amount of money these commodity traders make. That was their aim. The sustainability of this in the short run is looking achievable, but in the long run, it's not looking achievable, because by the time market comes to play and even the global supply is forecasted to fall, the global demand for this commodity has already started falling. However, the demand is falling more than the supply, and this is going to put downward pressures on prices. So the sustainability of this, by the time people are looking at, okay, I need to buy cocoa, or I need to buy, usually they buy about 50 tons. Now they're going to be buying about 20 tons or something. So if you continue to put premium price on it for a very long time, people will move and look for other ways to buy it that are cheaper. So the sustainability of that premium price is not achievable in the long run.
All right, thank you very much for your time, Aisat Dahoud. And Somalia expects to announce the winner of its first oil and gas licensing round early next year as the country seeks petrodollars to help rebuild its struggling economy, battered by violence and an Islamist insurgency since clan warlords overthrew a dictator in 1991. Somalia is offering 7 deep water offshore blocks in its maiden licensing round in one of the world's last frontier markets. The oil and gas auction officially opened on Tuesday. The government had previously mooted offering 15 blocks in this licensing round, but cut this down to 7 due to capacity constraints. Seismic data previously indicated the 15 blocks could contain around 30 billion barrels of oil. And that's it on the program. Thank you for watching. I'm Chimeze Obi Iwagu.